The S&P 500 closed down 10.3% from its recent all-time high, marking a technical correction. What happens from here?
Based on our study of all historical corrections, one of three things is going to happen. The first and lowest probability is going to be that the policy, fiscal and monetary response overwhelms markets and we get right back to all-time highs. The other two outcomes are about 50-50. One is the market retests these lows, the economic data hangs in there, and markets recover. The other is the retest of the lows fails, and then we get into bear market and potential recession territory. So with this technical correction, this portion of my portfolio is down over 10%. How difficult is it going to be for me to make up those losses?
That's highly dependent on your time horizon. If you have a time horizon of 10 years, for example, your average return since 1960 is right around 10%, and you've had a positive return over 90% of the time. But in order to realize those returns, you'll have to go through, on average, about 4 of these technical corrections, 2 bear markets, and about 1.5 recessions. There's always risk for the reward.
Hello and welcome to the Deep Dive by STRAT. Today we are talking about a word that's been in the news a lot lately, correction. We experienced a technical correction in the S&P 500 on Thursday, March 13th. So the purpose of this video here today, let's put some historical context and probabilities around that and talk about where we may go from here.
Yep.
So the first thing we should do is define what a technical correction is, which is bigger than a dip, but not as big as a bear market.
Right. So we've studied every technical correction and bear market going back to 1960, even some before then. Our research team has looked into all of those, and we feel pretty confident we can talk about what are the commonalities amongst them. So we'll talk about that, and we'll talk about what the differences are. So a dip, you've probably never heard anybody sell the dip, right? Everybody always says buy the dip. A dip is when the S&P 500 or another stock market index goes down somewhere between 5 and 10%.
Yep.
And if it were only that easy, right? If you knew you were only going to go down 8% and not 20, then it would be really easy to confidently buy the dip. But it's hard because a dip can turn into a correction.
Right.
And a technical correction is when the stock market index goes down more than 10%, but less than 20%. And then finally, a bear market is when you're down 20% or worse from your recent high or your all-time high. So as you said, we're currently in a technical correction. So on Thursday, March 13th, the S&P 500 closed at 5521. That is 10.3% below its all-time high. So there you have it. You have a technical correction. Now there's some vernacular here, some terminology we want to define up front. We had our initial down move, that first move down, 10% down from the all-time highs. Then what you'll see if we look at a prior technical correction, we're looking at the one from 2015, 2016 when the yuan was being devalued. Yeah. What you typically see is that first down move, it's like the market sending a warning shot, right? And it's very similar between a technical correction or something that ends up being a bear market. The market tends to shoot first and ask questions later, right? And then whatever the market's concerned about, they're waiting to see if whatever data they need to see is improving, whatever policy response they need is going to happen, right? And if it does, what you'll typically get in a technical correction is a series of retests, if you will, where the market over the next even year or so, in this instance, we would say, it would come back down to something near 5521, but not go lower than that. Because the data is starting to come in, maybe not as bad as expected, maybe you're getting some type of policy response, and the market is starting to gain confidence that that low that was established before is the low.
Right.
It's a support level, right? So a retesting. Whereas in bear markets, the data eventually fails,
right,
and the policy response doesn't come.
Either inadequate or doesn't come.
Exactly. Yep, that's the big difference. But as of right now, you know, we're 1 week out. We're like here. So very early in.
A little early. So let's talk a little bit about how this has played out historically, right? So we've had 27 of these play out before. This is the 28th technical correction since 1960.
Yep.
So unconditional historical probability, 43%. You're going to get one of these about every 2.5, 3 years.
Yep.
technical correction. What happens, or what historically has happened from there?
Yeah. So if you view this as like the map in the mall, right? You are here, right? So where do you go next? One is we just recover. So next stop is all-time highs. There's no retesting of the lows, trying to find a bottom, none of that. You just keep going higher. That's only happened one time, but it was actually the last technical correction that happened in fall 2023. We were down 10%, and then, as you said, there wasn't even time to retest the lows because you got the Powell pivot, and all of a sudden now the market's thinking about rate cuts, and we're off to the races. So unlikely. The next most likely move is retesting, meaning we're not going to go, the market wouldn't go lower from here, but it would keep testing that low of 55.21 on the S&P until it starts to gain confidence that's a bottom. And then finally, you have a 52% chance, so 14 out of the past 27, where the 10% down move that we had would just be the starting point, and you would have multiple moves lower. The data is coming in worse than expected. The policy response is not coming to the rescue, and it opens the door to bear markets and recessions and nasty things.
Yeah, that's where you really get into recession fears and recession occurrences. So if we break down that kind of probability of recession backwards and we say, okay, unconditionally in any given year, about a 15% probability of a recession occurring, right? If you experience a 10% technical correction, you get up to 9 in 27, so about 1/3, 33% chance of a recession occurring. And then if that correction becomes a bear market, that's when you start to get 50-50.
Exactly.
About a coin flip chance of a recession if that plays out. So, as investors and helping clients manage their portfolios, when we start talking about recession fears, how do we combat that? How do we, help investors navigate this efficiently?
Yes. There are two primary ways. The first one is just remembering time horizon. So the chart we have here to show this, we're looking at now rolling time periods, rolling 3-year, 5-year, 10-year, and 20-year time periods, returns for the S&P 500 since 1960. In any given 20-year period within that time window, your average return, if you just bought and held the S&P 500, was 10.1% annualized. Your worst outcome was positive 3.9% annualized return, which coincidentally was positive. So you have positive returns every time. Outperformed cash in 99% of 20-year time periods, and outperformed inflation in 100% of the 20-year time periods. So that seems like a great outcome. It almost seems like there's no risk, right? But that's not the case. In order to get that reward, the risk you take is, on average, over a 20-year time period, you're going to have to go through 8.6 technical corrections, 4.3 bear markets, and 2.8 recessions. And every single one of those is going to feel scary and is going to be fear-mongered in the news, right? So that is the risk you take for the reward. Now, say, all right, well, what do you mean by time horizon? I have a long time horizon, you have a time horizon. It's more so how long until you have to withdraw a significant portion of assets from whatever pool of money you're talking about, right? And so let's go to something as short as like 3 years. There, your average return over a 3-year time period is still 11.3%. So that's still pretty good. Your upside risk, meaning the risk to getting returns higher than that, is actually greater than the risk of getting returns well below that. But there are some bad outcomes, that are associated with things like when the tech bubble burst or when we had the global financial crisis, right? And those can be damaging. If you have a 3-year time horizon and your portfolio, or a portion of your portfolio, hopefully, right? Just a portion is invested in US large cap stocks, is down 17%, that can be damaging to achieving your financial goals, right? So we need to get a little more specific around, you need to have the appropriate level of risk before this happens, if your time horizon is that short, because this can happen, right? So you need to plan ahead. And then also remember that these are the probabilities, over any 3-year time period. But if we already had a 10% down move, all of these returns shift up.
Yeah.
So now you're looking at a really high probability of having a positive return, outperforming cash, inflation, et cetera. So remembering your time horizon, having the appropriate level of risk coming into this,
right?
Before we start talking about technical corrections.
Yeah. And to the point of that shorter time horizon, and you alluded to the importance of diversification, right? When we start to get into this territory, technical correction from an S&P 500 standpoint, we start to look at, okay, how is the market behaving? Mm-hmm. What probability is the market assigning to a recession? Yes. And so what we're looking at here is year-to-date max drawdown for various areas of the market, and then what has been the average drawdown during a recession. And from those two numbers, we can get what is the implied probability based on recent price movement.
Right. So you would read it as thus far, so in this technical correction we're in right now, the 10-year Treasury yield has gone about 0.6% lower than it was. But in a typical recession, it moves 2.5 percentage points lower than it was. So about a 26%
about a quarter of the way
implied probability of a recession. You do that same calculation for value stocks, S&P 500, and then finally the Russell 2000, which represents small cap stocks in the US. There you were down 18%, but in a typical recession, down 39.6%. So do the math there, about a 46% implied probability of a recession. So that's a key part of our investment framework.
Yeah.
Because the market is pricing in a typical probability of a recession after a technical correction happens, right?
Yeah.
30%.
Exactly.
But the recession is either going to happen or it isn't, right? And if it doesn't happen, then this is a buying opportunity. Of course, if it does happen, and you were to buy Russell 2000 or small cap stocks right now, and a recession does happen, you're probably going to go down another 20%, and it's going to be pretty ugly.
So the S&P 500 is saying, this seems kind of just like the rest of the historical technical corrections. If there's a recession, we're going to go down further. If not, we're probably going to recover. And to the point of, is there going to be a recession or not? Well, we think about that a lot. We put a lot of work into this recession signal. We did a pretty detailed overview of this in the most recent Outlook video, so feel free to check that out. But again, just highlighting, not active right now, but given those probabilities we just looked at from a market perspective, we start to take a more detailed look under the hood and start to see where could this potentially activate here near term.
Yep. In the next 2 to 3 months, we could start to see some more weakness in the real economy, particularly if a universal auto tariff goes into effect. It's possible that heavy truck sales will slow even further. And then new orders to inventory, as tariffs get enacted, they're going to put a huge kink in the inventory cycle and probably slow new orders. And so that could activate as well. So wait and see there, right? Markets were their most stressed on March 13th when the S&P 500 went into technical correction. But our market stress signal never activated. It never triggered because we didn't see enough weakness in things like credit spreads, high yield bond spreads, usually the canary in the coal mine, they didn't widen out enough. So that's also not active. And then finally, the labor market signal. There's been a lot of talk about how the layoffs are coming, the job cuts are coming. That data is not showing up in those cuts, that joblessness, that firing is not yet showing up in initial jobless claims. And it may not. It may not show up, right? So very low levels of initial jobless claims, nothing near recessionary levels.
Yeah.
And as we said, we've been talking to clients about this a lot, and the idea is, well, the job cut announcements just started, and maybe the filing for unemployment benefits, the initial jobless claims, will come later down the line. And that's true. Yeah. It may happen, but it's also possible, just like in 2022 and 2023 and 2024, that when those job cuts do materialize, rehiring also happens. And hopefully those folks are able to find another job and maintain their spending, and then it wouldn't be a recessionary outcome. So right now, not active. This can change very quickly. So we'll continue to provide updates.
Awesome. Yeah, recession signal will be a point of emphasis here going forward. And that will do it for this edition of the Deep Dive. If you have any questions or comments, please feel free to reach out.